Joining us now is Bernstein senior analyst Toni Sacconaghi. So, Tony, why was this such a surprise, the margin and profitability story? We know they've cut prices repeatedly this year.
Good morning, Sarah. So, look, I think the real question was the magnitude. Everyone knew they were cutting prices and margins were expected to go down. But the company said they won't go below 20% gross margins for automotive. And they came in below that already in the first quarter. Tesla said it wouldn't go below that level for the year. And with further price cuts just being announced this month, they're going to go even lower. So it was really a question of magnitude. There was some narrative that commodity costs were coming down. And so even though Tesla was cutting price, maybe margins wouldn't be as bad as investors thought. But ultimately they were, and they came in lower than Tesla's guidance and lower than street expectations. And that was really the incremental news for investors. As a result, earnings estimates have come down materially for next year.
Yeah.
I think in November of last year, people were thinking Tesla would earn $6 this year. Consensus estimates today are under $3.
So you're underperformed, price target 150. You've been negative, Tony, for how long on Tesla?
We've had a sell rating for a couple years now.
So at this point, how much is this part of the thesis, the bear thesis?
Look, we think risk reward is much more balanced now. We've had a pretty consistent price target of $150 for 2 years, and the stock went to $400. And our conviction has been, when we look out over the long term and try and value it on a discounted cash flow, $150 is the right price target. So we're obviously much more comfortable with the stock price here at 166 than we were when the stock was over $400. I still worry in the near term that we are going to see further price cuts. China has very limited lead time. Tesla has not cut price there this quarter like it has in the US and Europe. We think that's likely. That's probably not baked into numbers. And I think as we look to next year, Tesla wants to grow another 30, 40, 50% next year. And the challenge is it doesn't really have anything new coming to market. It has the Cybertruck, but that will be low volume. So how will Tesla grow 40, 50% again next year? It's probably going to put more pressure on margins. And so the near-term setup is pretty tricky for Tesla. And we think it's more likely that numbers may go down rather than go up. And that usually doesn't serve a stock well in the near term. On balance, longer term, we feel a bit better with the stock price down at this level relative to where it was a year ago.
We had you on in early April, Tony, and at the time we were talking about how rivals would respond to the price cuts. You said incumbents are pretty deep-pocketed and not likely to back down. That's kind of exactly what we heard from at least Renault today.
Yeah, so look, if I think about traditional OEMs who are making the transition to electric, investors are really putting most stock into how successful they are in their EV transition. And so if the EV transition is going to take more money to get there in terms of bigger losses, I think the OEMs are going to go along with it, because that's the key metric for investors today is how quickly can you transition to electric. And so even if margins have to be lower, I think most OEMs are going to say, so be it. We cannot compromise our ability to show that we can make the EV transition going forward. And so unfortunately, we're in a circumstance where we have a hyper-competitive industry. We have a leading player who's cutting price. And that's going to lead to worse profitability for the entire industry. But these are deep-pocketed competitors, and the priority is to move to electric. And so if profits have to be weaker in the near term, that's what they're going to do, I believe. That's the trade-off choice that they're going to make.